How's it going, guys? My name is Jack and welcome to my channel. And today I thought I'd share with you a story about the worst investment that I've ever made, because it is the perfect example of how not to invest in the stock market. I'll be going through 5 things that I did wrong in this particular investment, as well as things I could have done not only to offset my losses, but to actually make money out of the whole situation. Now, if you're new here, please consider subscribing and hitting the notification bell so you know when I post next, as well as hitting the like button. So in early 2018, it was brought to my attention that there was a company that was being listed for the first time on the Australian Stock Exchange. The only thing I knew about this business was that they were offering business-to-business, cloud-based cybersecurity and presented themselves as the first company to do this that is listed on the Australian Stock Exchange. And they were trying to raise $4 million at 20 cents per share as part of their IPO. I did a scan read of what they were offering, didn't really understand the space that they operated in, didn't really understand what product or service they were offering, to be perfectly honest. But the IPO was oversubscribed, which meant that there was enough hype and enough attention, so I kind of just jumped on the bandwagon. So with that decision, I committed 2 of the 5 new mistakes that I made in this one trade. The first is, I invested with speculation instead of proper research. Now, speculation is fine when you are investing in companies that are following a particular trend. So for example, in 2020, it was the year of lithium stocks. It was a year of buy now, pay later, big tech, e-commerce. You wouldn't have done very well if you invested in travel or if you invested in hotels and anything that was going against the trend of what was happening last year. There was a time in the dark ages, pre-pandemic, pre-1% interest rate, where the average person would be putting their savings into either a savings account, into an offset account for their mortgage, or into some kind of travel fund, as opposed to throwing it at GameStop call options. This was a time when companies were just minding their own business and social distancing was not checking your Facebook Messenger for a couple of days. Investing in a company that was operating in a market space I didn't know anything about, with a product that, from what I understood, didn't exist, and no financial record, is basically the trifecta of how not to invest. This was made especially bad because it was an IPO of a penny stock company where we just didn't have a very good gauge as to what the general public would value their stock value at. The second mistake I made was jumping on the bandwagon. 2020 is not the best example of generally what happens in the stock market. Intrinsic value is no longer a consideration, and every hype train in 2020 seems to just get more and more momentum, and everyone made decent money if they had hopped on board early enough. Value investors will tell you that if you've seen a stock in the news, or you've seen it in your Facebook feed because your cousin's uncle's father's dad, who bought that one stock one time, posted on his Facebook feed, then unfortunately you're too late to the party. Ironically, every stock that got this type of attention in 2020 seemed to only go upwards. Unfortunately, this was not the case with this particular company. Due to oversubscription of the IPO, the share was released to the public at 25 cents per share. Right after buying the stock, I just remember watching this price fall from 25 cents down to 16 cents, back up to 18 cents, but then just down to 10 cents, 8 cents, 6 cents, and then finally bottoming out and leveling out at 4 cents per share. The stock I had just purchased had fallen 84% in 9 months. So to do some basic maths with percentages, let's say I had a stock that was $100 per share and had fallen 50% to a stock price of $50. At $50 a share, the stock would need to double in value or increase 100% to make up for my 50% loss. In this particular scenario, this $100 stock had fallen 84% to a share price of $16. Now at $16, it would have needed to increase 525% for me to get up to where I was. So my mistake number 3 was not setting up some kind of stop loss that prevented me from getting to a point where I lost this much money. The same way that you can buy a share once it falls to a particular price, or sell it once it rises to a particular price, you can sell a share if it falls to a particular price to prevent any further losses. Now, I could have done this at 20 cents and only lost 5 cents a share. Exited out of my position immediately and used the remaining capital to basically wipe my tears and go and invest in something else. Over the following 2 years, the stock goes up and down from highs of 17 cents down to lows of 3 cents, but I really just didn't follow it. I'd basically given up on this company, and I wasn't following any of the news or any letters issued by the board of directors to see what they were doing to try and get me my money back that I had invested in them. During this 2-year period, I basically make my 4th mistake, which is not doubling down on what is already a fallen stock. Now, I already understood that 525% gains is something that was fairly hard to achieve, but doubling down on a stock would mean that I could break even at a lower point by averaging out my cost price for each share. For example, for the ease of maths, let's say I have 1,000 shares that I bought at 25 cents, which comes to a total of $250. Let's say I doubled or tripled down and bought 10,000 shares when the stock price was at 5 cents at a total cost of $500. I would have a total of 11,000 stocks at a total cost of $750, or roughly 6.8 cents a share. Selling the shares at a higher price than 7 cents would have been enough. However, thinking this was a dead investment, I ended up selling it at 5 cents a share because I was just sick of looking at it as a complete eyesore next to all my board of winners. So this is my 5th and final mistake, which was the number 1 rule is I've realized a loss by selling a stock. As with all stocks, all losses are paper losses until you actually sell that particular share. Selling the stock for 5 cents meant that I had basically admitted defeat and was forfeiting 84% of the money that I put into this particular company. It's pretty hard to lose any more than 84%. Losing this type of money is more like gambling than it is really like investing. One thing I didn't consider, and for whatever reason didn't register with me until a little bit later on, was a lot of these small penny stock companies rely on one bit of good news for their stock to skyrocket. If you're in the game and you're holding a particular stock, there are multiple ways that you can manipulate your pricing to get to a point where not only you can break even, but make a bit of money. This particular company is Whitehawk, and if you look at the stock price right now, as of 2021, their stock price is actually up at 40 cents per share after a string of good news and some new contracts that they've won. So even with all my mistakes of not doing any research, jumping on the bandwagon, not having a stop loss, and not doubling down, I would have still made money on this particular investment if I had held on to the stocks long enough. Not only that, I would have come pretty close to doubling my initial investment as opposed to losing 84% of it. Don't let this story deter you from investing, because what you've hopefully seen is, even in this scenario, there were multiple opportunities for me to stack the deck in my favor. And even if I didn't, if I had just held on long enough, I would have come out the other side with a nice green investment as opposed to a big fat red number. So basically that's the story of the biggest loss I've ever made investing in stocks. So the question is, if you're in the same situation, would you have done the same thing as what I did and just admitted defeat and sell the stock at a loss? Or would you have held on, or even smarter, maybe doubled, tripled, quadrupled down on that position once it was at the bottom and be in a position where you're making 3 to 4 times what you've initially invested in? Leave a comment in the section below and let me know what you would have done if you're in my shoes. And if you're curious about investing and want to get started, you can get a free stock valued up to $150 USD if you sign up to stake using the link in my description. And until next time, remember, don't lose any money.